Welcome everyone to a pivotal edition of Updates with John. Today, we are confronting a number that is causing significant concern across the financial landscape: $56. That is where silver is currently positioned as of Wednesday, June 25th, 2026. This represents its lowest valuation in 6 months, plummeting below the $56.10 March support level that many analysts confidently characterized as an unbreakable floor. It has breached the 200-day moving average and every other technical support level that bullish investors relied upon during the recovery from the March lows, which eventually culminated in January's historic peak of $121. Furthermore, the gold to silver ratio has surged to 74-1, its widest margin since the most chaotic weeks of the Iran conflict. To put this into perspective, it currently requires 74 ounces of silver to acquire just 1 ounce of gold. Merely 6 months ago, at silver's zenith, the same ratio stood at a much more balanced 46-1. This morning, at 8:30 a.m. Eastern Time, the May Personal Consumption Expenditures (PCE) inflation report, the Federal Reserve's preferred metric for gauging price stability, is scheduled for release. The data contained within this report will either substantiate the deepest fears regarding silver's decline or initiate the process of deconstructing them. Regardless of the outcome, by the time we conclude this broadcast, you will possess a comprehensive understanding of the forces at play, the validity of various market perspectives, and the true significance of the current market state. The charts are indeed telling a story, but it is likely not the one being popularized by mainstream financial media. The surface-level narrative is seductive in its simplicity. Silver experienced a meteoric 247% rally from $35 to $121, but following a peace agreement and a hawkish pivot by the Federal Reserve, the rally has concluded, leaving the price at $56. While this narrative is factually grounded, it is analytically incomplete. It omits crucial nuances that are essential for any informed investor. Silver's descent from $121 to $56 is not a singular continuous event. Rather, it is unfolded in 2 distinct phases that most commentators are erroneously conflating. Phase 1 was characterized by the geopolitical tensions surrounding the Iran conflict, the subsequent oil price shock, and the Federal Reserve's hawkish response that developed from February through June. This phase exerted genuine pressure on silver through a clearly identifiable mechanism. Surging oil prices propelled headline Consumer Price Index (CPI) inflation to 4.2%. In response, the Federal Reserve signaled its intent to raise interest rates, leading to higher real yields and increasing the opportunity cost of holding silver, a non-yielding asset. This was a logical and predictable transmission chain that resulted in a quantifiable decline. Phase 2, however, is what is currently being misconstrued. This week, we are witnessing silver falling toward the $50 mark, even as oil prices have significantly retreated. WTI crude is currently trading near $73 per barrel, approaching pre-war levels after a sharp 17% decline over 6 consecutive days following the US-Iran peace accord. This is precisely the development that was expected to alleviate the inflationary pressures driving the Federal Reserve's hawkish pivot. The conflict has ended and oil prices have fallen. The primary catalyst for the problem has visibly reversed, yet silver continues its downward trajectory. Why? Because the selling pressure we are observing this week has almost nothing to do with oil, geopolitical tensions, or even the Federal Reserve's current stance. The reality is that silver tumbled over 5% on Tuesday as a broader sell-off in technology stocks spilled over into the precious metals markets. Institutional investors, facing losses in their equity portfolios, liquidated their bullion positions to raise cash and meet margin requirements. Silver, being a highly liquid asset, was sold not because of a change in its fundamental thesis, but because it provided a ready source of liquidity during a period of broader market stress. This is not a referendum on silver's long-term value. It is a manifestation of forced selling, driven by dynamics in an entirely different asset class. The gold to silver ratio at 74-1 provides a diagnostic data point that is exceptionally revealing. While gold has declined by 1.7%, silver has plummeted by 5.4%. If the primary driver were simply the Federal Reserve's monetary policy, one would expect both metals to decline proportionally. The fact that silver is falling 3 times as fast as gold indicates that the dominant force is not a broad monetary headwind, but rather the specific pressure of forced liquidation and short-term cash raising that disproportionately affects the more volatile and leveraged silver market. History suggests that forced liquidation is a finite process. Once the necessary cash has been raised, the selling pressure dissipates, often leaving the asset's price at a level that is fundamentally disconnected from its long-term structural story. Historically, a gold to silver ratio near 74 has often signaled compelling entry points within a broader bull cycle. For instance, in August 2025, when the ratio was similarly elevated and silver was trading around $43, it surged to $77.50 within 4 months. In November 2025, a ratio of 72 preceded silver's climb to its $121 peak in January. These spikes in the ratio did not signal the end of the silver story. They represented temporary periods where short-term market forces overwhelmed the long-term thesis. Now, let us examine a data point that is frequently overlooked or misrepresented: the reduction in silver consumption by solar photovoltaic manufacturers. Recent data indicates a 19% decrease in silver usage per solar panel in 2026. This is not a sign of declining solar demand. Global solar capacity continues to expand rapidly, but rather the result of a concerted, multi-year effort by manufacturers to thrift silver, which is the most expensive component in their bill of materials. While this might seem bearish at first glance, the broader context tells a different story. Despite this 19% reduction in silver intensity, the global silver market is still projected to experience its 6th consecutive annual supply deficit, estimated at 46.3 million ounces. This is because mine supply is contracting at a rate that exceeds the reduction in industrial demand. This reveals a remarkably resilient structural story. The deficit persists even when a major demand category is actively reducing its usage. The long-term bull case for silver does not depend on increasing silver intensity in solar panels. It rests on the continued decline in mine supply and the steady or growing demand from other sectors like electric vehicles, AI infrastructure, and industrial fabrication. We must also consider the recent downgrades from major financial institutions such as Bank of America and Deutsche Bank. While these institutions possess immense research capabilities, the timing of their downgrades often coincides with local price lows. This occurs because the very forces that drive prices lower also compel analysts to update their models to reflect the new market reality. By the time these reports are published and discussed on financial news networks, the market has often already priced in the negative information. For example, Bank of America had a $6,000 gold target when gold was near $4,800. Their recent downgrade to a lower target reflects reality that has already transpired, not necessarily what is about to happen. Furthermore, some of the more bearish scenarios, such as gold falling to $3,800, are predicated on the Federal Reserve implementing 3 to 4 interest rate hikes in a single year, a level of tightening that seems unlikely given the current economic landscape. The 2026 inflation spike was primarily driven by a temporary energy shock related to the Iran conflict. With oil prices now significantly lower following the peace deal, the primary driver of inflation has reversed. A data-dependent Federal Reserve is unlikely to hike rates aggressively into a deflating energy price environment. This brings us back to the importance of today's PCE inflation report. If the core PCE data, which strips out volatile energy and food prices, shows that underlying inflation remains relatively stable or is trending toward the Fed's 2% target, it would undermine the hawkish narrative and could lead to a reassessment of future rate hike probabilities. The gap between the headline inflation number, which was influenced by the temporary energy spike, and the core inflation number, which the Fed truly prioritizes, is a critical factor that the market may be currently mispricing. In conclusion, the recent decline in silver's price appears to be driven by a combination of 3 factors: a genuine but likely temporary monetary repricing, a reduction in the safe haven premium following the Iran peace deal, and contagion selling from a broader technology sector correction. It is essential to distinguish between these short-term market dynamics and the long-term structural thesis for silver, which remains anchored in a persistent supply deficit and robust industrial demand. The current market volatility, while challenging, does not signify the end of the silver story. Rather, it represents an interruption in a broader, multi-year bull cycle. As the market eventually absorbs the short-term pressures and refocuses on the underlying fundamentals, a significant recovery in silver prices remains a distinct possibility. I urge you to stay informed, maintain a long-term perspective, and continue to monitor the key data points we have discussed today. If you find this level of deep, fundamental analysis valuable, please subscribe to Updates with John and hit the notification bell. My goal is to provide you with the insights necessary to navigate these complex markets with confidence. Until next time, this is John, signing off. Let us delve deeper into the significance of the PCE report. The Federal Reserve's preference for the PCE index over the Consumer Price Index, CPI, is not merely a technical detail. It is a fundamental aspect of their policy-making framework. The PCE index is considered a broader and more accurate measure of inflation because it accounts for changes in consumer behavior, such as substituting a less expensive good for a more expensive one, and covers a wider range of expenditures. When the Fed members look at the 4.2% headline CPI, they are aware that a significant portion of that increase was driven by the temporary spike in energy prices. If the core PCE, which they view as a more reliable indicator of long-term inflation trends, remains anchored near 2.9%, it provides them with the flexibility to be less aggressive with interest rate hikes than the market currently anticipates. This potential for a less hawkish Fed is a critical piece of the silver puzzle. Silver is often described as gold on steroids because it tends to move in the same direction as gold but with greater magnitude. If the PCE data provides a reason for the Fed to pause or slow its rate hike cycle, gold is likely to find support and potentially rally. Silver, given its current depressed valuation and extreme gold to silver ratio, could see a much more dramatic upward move as the short-term liquidation pressure subsides and the long-term structural deficit once again becomes the primary driver of price action. Furthermore, we must not ignore the historical context of silver's performance following periods of extreme volatility. The silver market has a long history of sharp corrections, followed by even more powerful rallies. The 2011 correction, from $49 to $26, for example, was a period of intense skepticism and bearish sentiment. Yet, it was followed by a significant period of consolidation and eventual growth as the underlying industrial demand continued to exert its influence. The current situation, while unique in its specific catalysts, shares many of the characteristics of previous market cycles, where short-term technical and liquidity factors temporarily overwhelmed the long-term fundamental story. Consider the role of silver in the burgeoning green energy economy. Beyond solar panels, silver is an essential component in the manufacturing of electric vehicles. An average EV uses significantly more silver than a traditional internal combustion engine vehicle, primarily in its complex electrical systems, battery management, and charging infrastructure. As the global transition to EVs accelerates, this source of demand is projected to grow steadily over the coming decade. Similarly, the rapid expansion of 5G telecommunications networks and the infrastructure required for artificial intelligence both rely heavily on silver's unique electrical properties. These are not speculative future demands. They are current, growing, and largely price-inelastic sources of consumption. On the supply side, the challenges facing the silver mining industry are significant and enduring. Silver is primarily produced as a byproduct of lead, zinc, and copper mining. This means that silver supply is not solely determined by its own price, but also by the economics of these other metals. Years of underinvestment in new mining projects, combined with declining ore grades at existing mines and increasing environmental and regulatory hurdles, have created a situation where mine supply is structurally constrained. Even if silver prices were to double tomorrow, it would take years for new supply to significantly impact the market. This combination of robust, growing industrial demand and a structurally constrained supply is the core of the silver thesis. The current price of $56, while painful for those who purchased at higher levels, does not change these underlying realities. In fact, by discouraging new investment in mining and potentially accelerating the depletion of above-ground stockpiles, low prices may actually be sowing the seeds for an even more dramatic price spike in the future. The gold-to-silver ratio at 74:1 is a loud, clear signal that silver is significantly undervalued relative to gold based on historical norms. While it is true that the ratio can remain elevated for extended periods, it has a strong tendency to eventually revert to its long-term mean. When that reversion occurs, it is almost always driven by silver outperforming gold. For an investor with a long-term horizon, these periods of extreme divergence often represent the most attractive opportunities to rebalance or increase exposure to the undervalued asset. As we await the PCE data and the subsequent market reaction, it is important to remain disciplined and focused on the facts. The noise of daily price fluctuations and the sensationalized headlines of financial news can easily lead to emotional decision-making. By understanding the deeper currents, the structural supply deficit, the enduring industrial demand, and the mechanics of the paper market, you can navigate these periods of volatility with a sense of perspective and purpose. The journey of silver in 2026 has been nothing short of extraordinary, from the heights of $121 to the current challenges at $56. But the story is far from over. The fundamental forces that drove the initial rally have not disappeared. They have merely been temporarily obscured by a confluence of short-term factors. As these factors resolve, as the peace deal stabilizes energy prices, as the Fed adapts its policy to the new inflation data, and as the forced selling in the equity markets concludes, the stage will be set for the next chapter in silver's multi-year bull cycle. Thank you for joining me today. Your support and engagement are what make this channel possible. If you find this analysis helpful, please share it with others who may be interested in a deeper understanding of the precious metals markets. And don't forget to subscribe and hit the bell icon to stay updated on all our future broadcasts. This is John for Updates with John, reminding you that in a world of paper promises, the truth is often found in the physical reality. Stay vigilant, stay informed, and I will see you in the next video.